Hello, everyone. Time to give an economics update. We've had some very important data recently come out. So I just want to kind of talk about it for my audience to get you up to date on a few things here. So first one will be employment numbers. Came out on Friday. Very strong number in Canada. So the number was 154,000 jobs were created. Consensus was looking for 38,000 jobs. So obviously it's a very strong number and a very big beat, right? Again, one thing to kind of keep in mind, and not to dampen the numbers, but some of these would be, people who, let's say, decide to take a step down in their job, right? So they might have a higher skill set, couldn't find a job, and then they just tried to get any job for now because benefits were expiring, sort of idea, right? So, it's still a very strong number. Anytime that many jobs created is a very strong number. However, it might not be, perfect number, okay? But the employment side, again, the trend is moving in the right direction 100%. So 6 months in a row now, we've had positive job growth. That's a very good thing. Year to date, so from January 1st until now, Canada has created 831,000 jobs. Again, very good number. Even now, historically, if we're looking at it pre-pandemic, this point right now, we have 186,000 more jobs than we had in February 2020, which, as you remember, is right before COVID started, right? So even at that point, the economy was moving in a very good direction. Interest rates were a lot higher. Things were moving along nicely. And right now, we have 186,000 jobs that we had at that point, okay? So the job front, things are very, very good. And if you watch my videos, you know there's three things I usually discuss: employment, GDP, and inflation in terms of, gauging the economy and when I think the Bank of Canada starts to hike rates, okay? So now on the GDP front, 2 weeks ago they came out with their Q3 number. It was about 5%. So a very strong number, and it's tracking now for an annual rate of 4.5%. Last year was a negative print. Obviously, there's a lot of lockdowns, COVID, etc. I think it was down about 5% last year. So right now we're going to recover. We're going to, the economy is going to grow at 4.5% this year. Very good number moving into 2022. Now, inflation obviously continues to run hot. I'm sure you've seen all the headlines, close to 5%. Stuff's expensive these days. Gas, house prices, food prices, everything you spend on is costly. Now, why isn't this a good thing? Because obviously your wages don't really increase by that much, right? So affordability becomes an issue. If everything's more expensive for consumers, they're going to spend less. They're going to get out there and do less because it's just more costly. That is a negative for the economy. So the Bank of Canada always wants that rate to be closer to 2%, which is just a normal rate, normal growth rate, such that life moves on normal. When it's at 5%, that's a little too high. One way to combat that is by raising interest rates, which the bank will be doing soon. So now onto the Bank of Canada. They had their announcement yesterday, and as expected, didn't do anything on the rates, kept it unchanged at 0.25%, and kept their QE policy the same. However, going forward, this is where it starts to get interesting because next year, obviously, we know interest rates are going to be going up. It's how much are they going to go, when are they going to go, and how fast are they going to go, right? And obviously, this will have implications on the economy and the housing market, housing prices, supply and demand, right? Or more demand. Um, so right now, the next meeting is January 26th. The market is sort of pricing in 50-50 whether or not they hike at that rate, that meeting or not. I think this is very aggressive. I don't think they can hike yet. There's still 6 weeks of data, granted. So yes, a lot can happen in the next 6 weeks. However, there's also some potential risks to the downside. One, obviously, being COVID, the Omicron variant now. What's going to happen? How's that going to develop, right? So with uncertainty now, we sit back and we wait to see what kind of impact this has on the broader economy, right? Will it go and spread like crazy and be very transmittable and just cause lockdowns, close down international travel, et cetera, et cetera? If stuff like that starts to happen and becomes a bad thing, then obviously that's a negative, and that may slow down the Bank of Canada progress. However, if it becomes a non-event and it's just sort of like life as usual, sure it's around, but it's not really that detrimental to things, then the Bank of Canada should be on pace to start hiking where the market expects them to hike, okay? Not January 26th, in my opinion. However, right now, most of the banks, and I've just kind of went through some of their forecasts today, most of them are expecting April hike. The interest rate policy meeting will be April 13th, and that's where most of the banks expect them to hike first. by 25 basis points. All right, so generally what happens is on these policy meetings, the bank will decide whether they're going to raise rates or not. And it's usually 25 basis points, which is 0.25%. So right now it's at 0.25%. The first hike will be 25 basis points, which takes it to 0.5%. Then every subsequent hike after is generally always 25 basis points, okay? So April 13th, RBC expects the first hike, and they expect two more hikes in 2022. CIBC expects the first hike April 13th and two more hikes 2022, sorry. And then BMO, now same thing. April 13th, they expect the first hike. However, BMO is very aggressive and they think 4 hikes in a row. April, May, June, July, the bank goes 25 basis points each time. Again, I think that's super aggressive because generally what the bank likes to do is they'll start to hike maybe once or twice, and then they'll pause because there's always a bit of a lag effect. You want this to now ripple through the economy and see what happens. So it doesn't really make sense for them to go 4 in a row, because then if they went too far too fast, then it just makes it harder to kind of pull back, right? So I think it's a little bit more sensible that, they go twice and then they pause for a little bit and then they hike again, right? So 3 hikes next year is very possible and plausible, okay? Now, how does this impact everything? Of course, now it's going to impact the housing market, but to what extent, no one really knows, right? Will it impact demand? Sure. Some demand might be brought forward now in the earlier months of winter, like say January, February, March, before this impending rate hike. However, what happens is as the interest rate curve starts to go up, mortgage rates are based off of that. So once the market starts to price in these rate hikes, the banks will then start to implement that into their rate hikes, into their mortgage rates. So it's not like you can really get ahead of it and say, okay, they're going to raise April 13th. I'm going to go buy in March and take advantage of low rates. No. Once the market starts to price it in, it starts to get priced in even earlier than the hike. So it's just one thing to think about. If you're thinking about buying in the next little while, you might want to kind of do it, consider sooner rather than later to lock in that lower rate before they start to raise. That being said, on the other side of it, when rates start to go up, will it have a big impact on things? Not necessarily. Again, right now we're at ultra low rates. If the Bank of Canada starts to raise by 25 basis points once, twice, 3 times even next year, that's only 3/4 of 1% higher than it is right now. Historically, your mortgage rate will still be extremely low. On the largest purchase of your life, amortized over 25 years, is not material. The monthlies will not change significantly, such that even if you bought next summer, even in fall, and the bank starts to hike, it's not going to be material. You won't even notice a big difference. What you have to think about is if you're going to look to buy in the next 2, 3, 4 years. Yes, rates will be probably 2-3% higher than it is now, potentially 1.5-2% at least higher than it is now. If you're on a floating rate note, a floating rate mortgage, which I know a lot of people are, your borrowing costs are going to go up because now as prime goes up, everything's priced off of that. With that spread, it gets higher, right? So again, it's that forecasting of when does the bank start to go and what you should do. Okay, these are conversations I have with my clients. Happy to sit down with any of you guys and have a more in-depth conversation. I know this area very well. I worked for the bank on an interest rate trading desk for 12 years. This is what I tracked very closely in my day-to-day job working for the bank, okay? We can have very deep discussions as to my views on things. I can explain a lot more. This is just a quick little tidbit in terms of more economic data that came out and what you should be thinking about. Happy to have a sit down with any of you or a phone call or anything to further discuss. Thanks for watching, and if you have any questions, hit me up, give me a ring, shoot me a DM, whatever, I'm around, okay? Thanks a lot. Bye-bye.